Hey, welcome back to the channel, financial aficionados. Today, we're tackling a question that gets a lot of people sweating. Can capital gains push me into a higher tax bracket? It sounds like a scary question, right? Well, don't worry, I'm here to break it all down for you with no fluff, just straight answers and a bit of humor to make the ride fun. Before we dive in, do me a quick favor. Like this video, subscribe to the channel if you're new here, and share this with your friends or family who need a little extra financial know-how in their lives. Trust me, your grandma's gonna thank you when you save her from tax trouble. Alright, let's get this tax party started. First things first, let's make sure we're all on the same page about capital gains. Now don't zone out on me just yet. I promise this isn't as boring as it sounds. Capital gains are the profits you make when you sell an asset for more than you paid for it. That could be stocks, real estate, bonds, or even that vintage baseball card collection you're secretly sitting on. If you buy a stock for $100 and sell it for $150, you've got a capital gain of $50. Pretty simple, right? And the IRS is waiting for you to report that gain, like a hungry bear waiting to pounce. But don't worry, you can manage this. You just need to know how the whole capital gains tax thing works. Now, let's break this down further. Short-term capital gains versus long-term capital gains. They're not the same, and this is a big deal when it comes to taxes. A short-term capital gain is any gain from an asset you held for 1 year or less. These bad boys are taxed at ordinary income tax rates, which can be as high as 37% in the US. So if you sold your stock after holding it for 6 months and made a $10,000 profit, you could be paying a big chunk of that back to the IRS. But if you hold on to the asset for over 1 year, it turns into a long-term capital gain. The tax rates here are much friendlier, 0%, 15%, or 20%, depending on your income level. So the lesson here, don't be that person who buys and sells a stock like it's going out of style. The IRS loves that short-term action, but they love taking a bigger chunk out of it. That's like buying a sandwich for lunch, but then giving the cashier your whole wallet instead of just a tip. Not cool, right? Now let's get to the heart of the matter. Can capital gains push you into a higher tax bracket? Brace yourselves because the answer is, yes, it absolutely can. Here's how it works. Your total income for the year is used to determine your tax bracket. This includes your salary, wages, business income, and yes, you guessed it, capital gains. Let's say you're making $60,000 a year from your job, and then you sell some stocks for a $15,000 gain. Suddenly, your total taxable income for the year is $75,000. Now, if you were previously in the 12% tax bracket, that $15,000 in capital gains could push you into the 22% tax bracket. So not only is your job income taxed at the 22% rate, but that capital gain is now taxed at the higher rate too. Imagine going from a comfy beach chair in the 12% tax bracket to the hot, sweaty 22% tax bracket. That's the equivalent of being told to move from the cool VIP section of the party to the overcrowded dance floor. Not fun. Okay, but let's not panic just yet, because capital gains tax rates are not one size fits all. The IRS has different rates based on your income level. So let's break this down by tax bracket. If your income, including capital gains, is under $44,625 for single filers or $89,250 for married couples filing jointly, you pay 0% on long-term capital gains. Yes, you heard that right, 0. It's like the tax fairy came down and sprinkled some magic dust on your profits. If your income is between $44,625 and $492,300, single, or $89,250 and $553,850, married, your capital gains are taxed at 15%. Still not bad, right? But if your income exceeds those thresholds, you could be taxed at 20% on long-term capital gains. So, it's kind of like this. The more you make, the more the IRS wants to take. But hey, that's life, right? No one said taxes were supposed to be fun. Now let's talk about how you can minimize the impact of capital gains taxes and avoid pushing yourself into a higher tax bracket. Here are a few strategies to consider. Hold on to your investments longer. Like we discussed earlier, holding on to an asset for over a year qualifies it for the lower long-term capital gains tax rates. Patience pays off, literally. Tax loss harvesting. If you have other investments that are losing value, you can sell them to offset your gains. This is called tax loss harvesting. Basically, you sell your losers to cancel out your winners. It's like the financial version of getting rid of your junk in the attic for a tax break. Max out your retirement contributions. Contributing to tax-deferred accounts like a 401k or IRA lowers your taxable income. Lower taxable income equals less tax on your gains. It's a win-win. Here's a pro tip. You can also avoid the so-called stealth tax increase by managing your capital gains distribution. If you're nearing a higher tax bracket, you might want to consider spreading out the sale of your assets over multiple years instead of cashing everything in at once. This keeps you from jumping into that dreaded higher bracket in one fell swoop. Imagine being at an all-you-can-eat buffet, but only taking a few plates at a time to avoid looking like a glutton. Small bites keep the IRS from getting too hungry and raiding your wallet. So there you have it, folks. Capital gains can absolutely push you into a higher tax bracket if you're not careful. But now you know the ins and outs of how it works and how to plan around it. Before you go cashing out those stocks or real estate profits, make sure to give this video a thumbs up, subscribe for more financial tips, and share this with your friends who might be about to make a big capital gains move. Thanks for watching, and as always, I'm here to help you save money, avoid mistakes, and make the most of your financial journey. I'll see you next time, tax-free, of course.